On October 2nd, something unprecedented occurred in the silver market, something that hadn't happened since 1980. The spot price began trading higher than futures contracts. For the first time in over 4 decades, the paper market and physical market diverged. 800 million ounces, 4 consecutive years of deficit, and now governments are moving, China restricting exports, the United States declaring silver a critical mineral. Craig Hemke, after 15 years of analysis, is making his most aggressive forecast ever. Not $50 silver, not $80 silver, but $120. And gold at $6,000 per ounce by the end of this year. The question isn't whether the system can hold. The question is, how much time is left? Welcome to Currency Spot, where we bring you the financial insights that truly matter for your wealth and your legacy. Now, if you've been following markets for a few decades, if you remember when silver hit $50 back in 1980 or 2011, then you know this: timing and information are everything. We're building a community of seasoned investors, business professionals, and strategic thinkers who understand that the financial system is changing faster than ever before. So here's what I'd like to ask you, my friend. Hit that subscribe button right now. Not because I'm asking for a favor, but because you deserve to stay ahead of what's coming. And while you're at it, drop a comment below and let us know. Where in the world are you watching this from? Are you in the United States, the UK, Australia, Canada, India, Pakistan? We want to know. Because this isn't just an American story. This is a global monetary shift, and your perspective matters. So go ahead, subscribe, hit the notification bell, and tell us your location in the comments. Let's get started. October 2nd marked a turning point that most investors completely missed. While headlines focused on stock market movements and interest rate debates, a quiet fracture appeared in the silver market that hadn't been seen in over 40 years. The spot price of silver, the price for immediate physical delivery, began trading higher than the futures contracts. This phenomenon is called backwardation, and when it happens in precious metals, it signals something far more serious than a temporary price spike. It signals a structural breakdown in the supply chain itself. Craig Hemke has been analyzing precious metals markets for 15 years, and he's never been more convinced that what's happening now is fundamentally different from anything that came before. In 1979 and 1980, silver surged to $50 in just 4 months, then crashed back to $10 within 2 months. It was a speculative bubble, driven by the Hunt brothers attempting to corner the market. In 2011, silver again reached $40 on April 28th, only to collapse and spend the next 13 years in a grinding bear market. That too was speculation, fueled by post-financial crisis fear and loose monetary policy. But 2024 and 2025 have been different. Silver didn't spike and crash. It climbed steadily, persistently, despite every attempt to suppress it through paper market selling. And the reason is simple. This time, the move is being driven by physical scarcity, not speculation. 4 consecutive years of supply deficits have drained 800 million ounces from global inventories. 800 million ounces. To put that in perspective, total annual silver mine production is roughly 830 million ounces. That means the world has consumed nearly an entire year's worth of mining output from existing stockpiles, and those stockpiles aren't coming back. Industrial demand for silver has exploded, driven by solar panel manufacturing, electric vehicle production, and advanced electronics. At the same time, investment demand has surged as investors worldwide recognize that fiat currencies are being systematically debased. But here's where it gets critical. The price of silver and gold has never been determined by physical supply and demand alone. For decades, prices have been set through a fractional reserve system, where paper contracts trade at massive multiples to the actual physical metal available for delivery. On the COMEX exchange in New York, hundreds of thousands of silver contracts trade every single day. Each contract represents 5,000 ounces of silver, but the actual physical silver sitting in COMEX vaults represents only a tiny fraction of the paper claims against it. The system has worked for 50 years, because most traders never take physical delivery. They simply settle their contracts in cash. But when physical demand exceeds supply for years on end, the leverage in that system begins to stretch, and when it stretches far enough, it breaks. That's what backwardation signals. When spot prices trade above futures prices, it means the market is screaming for physical metal right now, not 3 months from now, not 6 months from now. It means the people who actually need silver, the industrial users, the refiners, the mints, are willing to pay a premium to get metal immediately, and that premium has been growing. In October, when silver first went into backwardation, the spread between spot and futures reached 30 to 40 cents. In early January 2025, during a particularly heavy selling session overnight in Asian markets, that spread appeared again, 30 to 40 cents. That might not sound like much, but in a market where prices are normally aligned within pennies, It's a flashing red warning light. Lease rates in London, the cost to borrow physical silver for short-term delivery, have also spiked. This tells the same story from a different angle. When lease rates rise, it means physical metal is tight, and those who have it are demanding higher compensation to lend it out. Meanwhile, vault stocks at major depositories have been declining. Not dramatically, not in a way that makes headlines, but steadily, persistently. The physical metal that underpins the entire fractional reserve pricing system is quietly disappearing. And then, in October, China announced export controls on silver, and the United States declared silver a critical mineral. These weren't casual policy decisions. Governments don't designate materials as critical unless they recognize a strategic vulnerability. Craig Hemke's forecast of $120 silver and $6,000 gold by the end of 2026 is not based on hype or hope or technical chart patterns. It's based on a simple reality. The physical foundation of the precious metals pricing system is cracking, and when that foundation finally gives way, the price discovery mechanism will shift entirely to the physical market. And in a physically driven market, with structural deficits and government export controls, prices don't move in small increments, they gap. January 8th, 2025, American traders woke up to see silver down 5%, no major news, no economic data release, no Federal Reserve announcement, just a sudden violent drop that wiped out days of gains in a matter of hours. The explanation, when it finally emerged, revealed something far more important than the price move itself. It revealed where price discovery is actually happening now, and it's not in New York anymore. The selling had started in Shanghai. Chinese regulators had raised margin requirements overnight, forcing leveraged traders to either deposit more cash or liquidate their positions. They liquidated. Silver in Shanghai fell 6% in Asian trading hours. And because Shanghai now represents one of the largest physical silver markets in the world, that price collapse rippled westward. When London opened, traders saw the Shanghai weakness and piled on with additional selling. By the time New York came online, the damage was done. 5%, gone. But here's what makes this significant. For 50 years, the price of precious metals has been set primarily in Western markets, London and New York. The COMEX exchange in New York has been the dominant force in gold and silver pricing since the 1970s, but that dominance is quietly ending. Physical demand in Asia, particularly China and India, has grown so large that Eastern exchanges are now driving price action. And Eastern markets operate differently. They're less focused on paper derivatives and financial speculation, and more focused on actual physical metal changing hands. This shift in price discovery from west to east is one of the most underreported structural changes in the precious metals market, and it's accelerating. Now, while this was happening, Western financial media was obsessing over something entirely different: commodity index rebalancing. In the first week of January, reports began circulating that major commodity indices, including the Bloomberg Commodity Index, were going to rebalance their holdings. Because gold and silver had performed so well in 2024, these indices were now overweight in precious metals. To rebalance back to target allocations, they would need to sell. The headlines were dramatic. $14 billion in gold and silver selling pressure. Massive liquidation coming. Zero Hedge published an article suggesting this could crash the metals markets. Banks sent notes to clients warning of impending volatility. And traders, especially newer traders, panicked. But Craig Hemke looked at the actual numbers and came to a very different conclusion. The Bloomberg Commodity Index rebalancing would require selling approximately 10,000 COMEX gold contracts. That sounds enormous, until you understand the context. Daily trading volume on the COMEX gold market averages between 150,000 and 200,000 contracts. And this selling wouldn't happen all at once. It would be spread over 5 trading days. So the actual impact would be roughly 2,000 contracts per day. That represents less than 2% of normal daily volume. It's not nothing, but it's hardly the catastrophic flood of selling that headlines suggested. Silver was similar. 10,000 COMEX silver contracts needed to be sold. Daily silver volume runs between 100,000 and 150,000 contracts on active days. Spread over 5 days, the rebalancing would add maybe 2,000 contracts of selling per day. Again, barely a blip in normal market activity. Yet the fear generated by these headlines was real. And that fear, not the actual rebalancing, caused temporary price weakness. By the time the dust settled, gold had bounced back into positive territory within 24 hours. The massive selling pressure had been absorbed without any meaningful disruption. This pattern, where non-events are amplified into market-moving narratives, happens repeatedly in precious metals. It's a feature, not a bug, of how modern markets operate. Algorithms scan headlines for keywords. When they detect phrases like selling pressure or liquidation, they execute program trades. High-frequency trading systems now account for 80 to 90% of total trading volume on the New York Stock Exchange. These aren't human traders making informed decisions. These are machines reacting to text strings, and this has had a particularly damaging effect on precious metals mining stocks. Despite silver rising more than 50% from mid-2024 through early 2025, the GDX mining stock index barely moved. In mid-October 2024, GDX was trading around a certain level. By early January 2025, after months of explosive gains in the underlying metals, GDX was only a few points higher. The reason is algorithmic trading. When the New York Stock Exchange opens at 9:30 a.m. Eastern, these systems immediately scan the COMEX futures prices. If silver is down in the first 2 hours of trading, the algorithms sell mining stocks. It doesn't matter that silver might be up 50% over 3 months. All that matters is whether the metal is green or red in that specific 2-hour window. And because futures markets are still heavily influenced by paper selling, mining stocks get systematically suppressed. Real investors, the ones putting capital into these companies based on fundamentals, watch in frustration as machines override rational valuation. But the machines don't care about fundamentals. They care about momentum signals, and those signals are still being generated in paper markets. Meanwhile, something much larger was developing in the background. The CME Group, which operates the COMEX exchange, had raised margin requirements twice in late 2024. Margin is the amount of cash traders must deposit to hold futures positions. When volatility increases, exchanges raise margins to protect themselves from client defaults. The concern was simple. If silver is moving 10% in a single day, and a trader is leveraged 20-1, a wrong way bet could wipe out their account instantly. And if that trader can't cover their losses, the brokerage firm is on the hook, so margins went up. What's interesting is that after the initial hikes, margins stabilized. Despite continued volatility in early January, the CME didn't raise them further. That suggests they found a level they consider appropriate for current conditions. But it also suggests they expect this volatility to continue, because the physical stress driving these price swings isn't going away. And governments, as it turns out, are about to make it much worse. Saturday morning, January 4th, 2025. While most Americans were starting their weekend, a military operation unfolded that would redefine how the world views U.S. foreign policy. 160 aircraft, Delta Force operators, a sovereign nation entered without warning. And within hours, Venezuelan President Nicolas Maduro was in custody, being transported to the United States. The speed was unprecedented. The boldness was shocking. But what came next was even more revealing. That afternoon, Secretary of State Marco Rubio stepped to the microphone for a press conference, and he said something that every precious metals investor needs to understand. Trump is not a game player. When he tells you he's going to do something, when he tells you he's going to address a problem, he means it. He actions it. This is a president of action. If he says he's serious about something, he means it. Craig Hemke was watching that press conference live, and he immediately understood what it signaled. For decades, American politicians have made threats they never followed through on. Sanctions, condemnations, strongly worded letters, but rarely, if ever, direct action. Trump said he would remove Maduro, and 72 hours later, Maduro was gone. This wasn't about Venezuela specifically. It was about establishing a pattern. When this administration says something, it happens. And that has enormous implications for precious metals, because this administration has said a lot about resources. Drill, baby, drill. Critical mineral designations, rare earth independence, copper security, uranium stockpiling. These aren't campaign slogans anymore, they're operational directives. And across the Pacific, China is doing exactly the same thing. In October 2024, China announced export restrictions on silver, not a total ban, but controlled licensing requirements that effectively limit how much silver can leave the country. China is the world's third largest silver producer. And now, that production is being ring-fenced for domestic use. Gallium, germanium, antimony, rare earth elements. One by one, China has placed export controls on materials critical to modern technology and defense systems. This isn't economic policy. This is strategic resource warfare. And the United States is responding in kind. In late 2024, the U.S. government officially designated silver as a critical mineral. That designation carries legal weight. It means silver is now considered essential to national security and economic security. It means domestic production will be prioritized. It means export restrictions, if deemed necessary, can be implemented with minimal bureaucratic resistance. The world's two largest economies are both moving to secure their resource supply chains, and they're doing it simultaneously. Craig Hemke describes this as a war footing, not a shooting war, at least not yet, but a strategic competition where control of physical resources is becoming more important than financial assets. And precious metals sit at the center of that competition. Gold, Because it's the ultimate monetary reserve in a world where fiat currencies are being weaponized, silver. Because it's irreplaceable in advanced manufacturing and green energy technology. Copper just hit $5,000 per ton in London, an all-time high. Not because of speculation, because every electric vehicle requires 80 to 100 pounds of copper. Because every solar panel installation requires extensive copper wiring. Because every data center, every 5G network, every military system runs on copper, and global supplies are not keeping pace with demand. The same dynamic is playing out across the entire critical minerals complex, but it's the government response that makes this cycle different. In previous commodity booms, governments largely stayed out of the way. Prices rose, prices fell, markets cleared. Not this time. This time, governments are actively intervening to secure supplies for their own strategic needs. And when governments compete for finite resources, prices don't behave rationally, they spike. Now, there's another element to this that sounds almost absurd, but it's being seriously discussed at the highest levels. Greenland. President Trump has repeatedly mentioned acquiring Greenland from Denmark. Most people dismissed it as typical Trump bluster, but then the details started emerging. Greenland has 50,000 residents. What if the United States offered each of them $1 million in exchange for a vote to become a U.S. territory? That's $50 billion. Expensive, but not impossible. And what if the offer was $10 million each? That's $500 billion. Still, theoretically achievable, but where would that money come from? The answer, according to Treasury Secretary Scott Bessent, is asset-side balance sheet monetization. Here's how it would work. The United States currently holds approximately 261 million ounces of gold. On the official balance sheet, the gold is valued at $42.22 per ounce. That's the statutory price set in the 1970s. And it has never been updated. At $42.22 per ounce, the U.S. gold reserve is worth about $11 billion. But the market price of gold today is over $4,000 per ounce. At market prices, that same gold is worth over $1 trillion. Now imagine the Treasury Department decides to revalue its gold holdings, not selling the gold, just marking it to market value. If gold were revalued to $10,000 per ounce, the Treasury would suddenly have $2.6 trillion in asset value. That's not new money being printed. It's existing assets being revalued. And here's the critical part. The Federal Reserve could then issue Treasury securities backed by that revalued gold and transfer the proceeds to a sovereign wealth fund. A sovereign wealth fund that Trump signed an executive order to create on February 2nd, 2024. No new debt, no bond sales, just an accounting adjustment that creates trillions in liquidity. That's how you buy Greenland. That's how you fund infrastructure. That's how you avoid a debt crisis while continuing to run massive deficits. Bessent explicitly stated in February 2024 that the plan was to monetize the asset side of the balance sheet. Most people ignored it. Craig Hemke didn't. Because if the United States revalues gold to $10,000 per ounce for accounting purposes, what happens to the private market price? It doesn't stay at $4,000. It goes to $10,000 and then higher. Because once a government sets a floor price through official valuation, the market price never trades below it. And if gold goes to $10,000, silver, with its historical ratio and its critical industrial demand, doesn't stay at $80. This isn't speculation. This is game theory. And the game has already started. 1 year ago, at the beginning of 2024, Craig Hemke made a forecast that was considered reckless by most analysts. Gold at $300, silver at high 30s. The reaction was swift and dismissive. Gold had just finished 2023 at around $2,600, already up 27% for the year. Analysts argued it was overextended, overbought, due for a major correction back to its 200-day moving average near $2,000. The dollar was surging. The newly elected Trump administration was promising massive spending cuts through the Department of Government Efficiency, known as DOGE. Fiscal discipline was supposedly coming. And in that environment, predicting another 20% gain in gold and 30% in silver seemed absurd. Hemke was called a permabull, a lunatic, a dreamer disconnected from reality. And then 2024 unfolded. Gold didn't correct to $2,000. It blew through $3,100. It reached $4,300 by December. Silver didn't stall in the 30s. It shattered $50, then $60, then $70, and briefly touched $80. By December, Hemke received an email from someone calling him an idiot, not for being wrong, for being too conservative. How could you only predict 10% for gold and 30% for silver? You must be a rube. You should have seen this coming. This, Craig Hemke notes, is the no-win nature of making forecasts in precious metals. When you're bullish and wrong, you're mocked. When you're bullish and right, you're mocked for not being bullish enough. So why make forecasts at all? Because patterns exist. And when patterns are consistent, they can be extended. Since March 2024, when gold broke out to new all-time highs, it has followed a remarkably consistent rhythm. 20% rally, 2 to 4 month consolidation, 20% rally, 2 to 4 month consolidation, over and over. In summer 2024, gold was trading around $3,500. Hemke calculated that a 20% rally would take it to $4,200 or $4,300. It went to $4,350. Gold then consolidated from October through late December. Now, in early 2025, it's preparing for another breakout. 20% from current levels puts gold at $500 to $200 by spring or summer. If that plays out, and gold consolidates again through mid-year, another 20% rally would take it to $6,000 by year-end. This isn't hopeful speculation. It's mathematical projection based on an established pattern. Will it play out exactly that way? Maybe not. Markets never move in perfect increments. But the underlying drivers supporting that pattern haven't weakened. They've strengthened. Central banks have been net buyers of gold for 4 consecutive years. Not small purchases, massive sustained accumulation. China, Russia, India, Turkey, Poland. Even nations traditionally aligned with the US dollar system are diversifying into gold. That buying creates a structural floor under the market. It means major sell-offs don't stick. When gold drops 5%, central banks step in and buy the dip. That support didn't exist in previous bull markets. In 1980, there were no central bank buyers. In 2011, central banks were still net sellers in many cases. This time is different. And that difference is why $6,000 gold is not just possible. It's probable. Now, silver. Silver finally broke out to new all-time highs in October 2024. It took gold 21 months to double from its breakout point in March 2024 to its peak in late 2024. If silver follows the same trajectory, it would double from its $50 breakout level to $100 within a similar time frame. But Hemke suspects silver might move faster, because silver has a smaller market, because silver has industrial demand that gold doesn't, because silver supply deficits are more acute. Michael Oliver, another veteran analyst with decades of experience, has projected $100 silver by the end of the first quarter of 2026. That's aggressive, but it's not impossible. If silver reaches $100 by spring and then consolidates, another 20% move would put it at $120 by year end. Again, this isn't hype. It's pattern recognition combined with fundamental supply-demand analysis. Now, what could derail this? What could cause gold and silver to collapse instead of continuing higher? The answer is a genuine economic collapse, not a recession. A collapse. If global industrial demand for silver suddenly disappeared, if the US government abandoned deficit spending and implemented true austerity, if the Federal Reserve refused to cut rates and allowed long-term yields to surge unchecked, if China stopped buying gold and started dumping reserves, then yes, the metals would fall. But how likely is any of that? The US government has already abandoned the pretense of fiscal discipline. DOGE, the Department of Government Efficiency, was supposed to cut $2 trillion from the federal budget. It didn't happen. It was never going to happen. Instead, the administration has embraced a run-it-hot strategy, cut short-term interest rates as much as possible. If long-term rates rise in response, implement yield curve control to suppress them, continue running $2 trillion plus annual deficits, fund infrastructure, fund defense, fund everything. And if the bond market won't finance it, monetize the asset side of the balance sheet, revalue gold, create liquidity out of accounting adjustments. This is the plan. It's been stated explicitly by Treasury Secretary Bessent. It was outlined in Trump's executive order on February 2nd, 2024. And when Craig Hemke says to take them at their word, he's not guessing. He's reading the actual policy documents. The Venezuela operation proved that when this administration says it will do something, it does it. So when Bessent says they'll monetize the gold reserves, believe him. When Trump says he's serious about securing critical minerals, believe him. When China says it's restricting silver exports, believe them. These are not bluffs. These are operational realities. And operational realities, not technical charts or sentiment indicators, drive long-term price trends. There's one more factor that needs to be understood: volatility. In the fourth quarter of 2024 and early 2025, silver has routinely moved 3 to 4% in a single day, sometimes 10%. Gold has moved 2 to 3% daily. For traders accustomed to slow, grinding markets, this has been exhausting. One massive green bar, followed by one massive red bar. Up $5, down $4, up $6, down $3. It feels chaotic, but that volatility is a feature, not a bug. It's what happens when a market transitions from paper-driven price discovery to physical-driven price discovery. The leverage in the system is being tested. Margins are being raised. Weak hands are being shaken out. And through it all, the price trend remains intact. Higher highs, higher lows. Consolidations that hold and then break out again. This is not a bubble inflating. This is a structural repricing. Craig Hemke has spent 15 years analyzing precious metals. He's seen the 2008 financial crisis. He's seen the 2011 blow-off top and subsequent collapse. He's seen every false breakout, every failed rally, every bear market grind. And he's never been more convinced than he is now. Not because of charts, not because of sentiment, but because the physical foundation of the pricing system is breaking. 800 million ounces of silver, gone. 4 years of deficits, continuing. Governments ring-fencing resources, accelerating. Central banks buying gold, unrelenting. Monetary debasement, inevitable. These are not speculative variables. These are established facts. And when facts align in a single direction, prices follow. $6,000 gold, $120 silver. By the end of 2026, not a prediction of what might happen, an assessment of what is already happening at an accelerating rate. The only question left is whether investors will recognize it in time.